Hello everyone, Sudesh here. Welcome to the second part of our session. So in previous session we were discussing about how to sell and buy a stock. So once an order to sell or buy a stock is executed, so these shares would be present in seller's demat account in electronic form. So these electronic shares would be taken from seller's demat account, then it would be added to buyer's demat account. So all the share certificates of the ownership of these 100 shares would be transferred from seller to buyer in demat form, which is dematerialized form. So that's how the complete trade ends. So this process of adding share certificates in demat form to buyer's account takes up to 2 days normally. It depends from broker to broker and the demat account that you holds. So what does it mean to own a stock? As I told you that you get a ownership or share certificate for 100 shares of that particular stock when you buy, such as in this case. So what does it really mean to buy 100 shares of a stock? So it means that if this company idea has in total of 1000 shares, this is just for representation purpose, they have crores of shares, and you have bought 100 shares of that company, which means that you are a 10% owner of idea company. So I know that this is very exaggerated numbers, so but always view from the point of view, whenever you buy a share of that company, you are becoming that much owner of that company. So always when you do the analysis to buy any stocks, do the analysis that you do if you are going to buy that business. So this is how Warren Buffett approaches his long-term investment. This is how he buys the stocks. Even if you are going for buying 1 share or 10 share or 100 shares, you should always analysis from the point of view that you are going to buy that business. I know that it would be the number of shares you buy doesn't make any much difference. So apart from owning, when you are owning the share, apart from the benefits that you get by the rise of price in the share, other than that you will also be entitled to other benefits like dividends. If company declares any dividends, you get same for that. If any split happens in the share, any bonus shares issued, you also get voting rights to the amount of right corresponding to the number of shares you own. So you will be entitled for all these benefits of that share. So owning a stock in real man's term is you owning that much percentage of a business. So take into that account whenever you do analysis for long-term buying. Next, returns on investment. So any investment that we do, we are always concerned about ROI, which is return on investment. For example, you have bought shares of idea at 98 rupees and the price of idea share rise and you sell it at 110 rupees. So you hold it for a period of 2 years and you sell it after 2 years at 110. So how would you calculate the returns? So there is a term called as compounded annual returns, rate of returns. So this is calculated as your initial price. So for example, here you're selling. So initial, when I say that initial price, there are, in this case you have bought initially, sold later. So if you go deeper into stock market trading, there are situations where you sell first and buy later. We will discuss that on later stage. So in this scenario, you're selling it at 110. So your profit is 110 minus 98 rupees, which comes around 12 rupees. So your initial investment was 98 rupees and you got a return of 12 rupees. So normal percentage calculation, 12 divided by 98 into 100, that would be your profit. So we can just calculate it. Which gives you around 12%. So which gives you around 12% returns. So this 12% returns is for 2 years. So for 1 year it would be considered as 6% returns. Since all our banking accounts etc. provides a return on annual basis, it would be always better to calculate your ROA on annualized basis. It would be much easier to comparison purpose. But if you had bought at 98 and sold at 110 within 6 months, then 12% return would be for 6 months. So annualized would be 24%. Okay. So next, trader versus investor. So now mostly for all laymen, they would have earned a lots of terminology called as trader or investor, and they consider it as same. But in real world scenario, trader and investor are totally different persons. So as per Robert Kiyosaki or Warren Buffett, they define trader as someone who is buying to sell, and investor as a person who is investing on a business. So trader is expecting the price of the stock to rise, so he is buying to sell it at a higher price and get the profit. Whereas investor is someone who is investing in that business, and he is not going to sell it. He doesn't want to sell that business to someone else. He just wants to invest it and wants that business to grow. So there are many traders like day traders who buy in the morning, sell by afternoon. There are swing traders who buys when the price of the stock is low and waits for a period of 1 or 2 months when the price gets back to higher, depending upon various news events or market triggers. Whereas investors, there are short-term investors and long-term investors. So as per Income Tax Department of India, they define short-term investor as investor who sells his stock within 1 year of the purchase, whereas long-term investor is someone who holds that stock for minimum a period of 1 year. So in Income Tax of India taxes a short-term investor at a flat rate of 15%, and for long-term investors there is no tax in India. And also the dividend income that you earn from trading those stocks are also not taxed. So in next section we will be discussing about IPOs, which is the primary market, how a private company becomes publicly traded company, how the initial public offering happens. We will just go through an overview on the next session. Thank you. Subscribe to channel. If you have any doubts, comment. I will reply back, get back to you. Stay connected. Thank you.